I've been in real estate investing for over 30 years and I've raised over $75 million. I built out hundreds of units, sat across the table from every type of investor you can imagine. And I can tell you, the reason you're still losing money in 2025 is because you're still making the same mistakes you were making 20 years ago. What do I mean by that? You think you're being smart, but you trust the wrong deals. You chase shiny returns and you miss the big red flags. Today, I'll give you the advice I wish I got when I was in your position years ago. Every sponsor says the same thing: preferred returns, strong upside, proven team. But passive investors keep falling for the same traps. They're overpaying in hot markets, trusting shiny deal decks instead of vetting the operator, and ignoring capital stack structures and fees while underestimating the risks on value add deals. In 2025, the bar has to be higher because the risks are higher, and so are the interest rates. Let me explain some of these things to you about overpaying in hot markets. We've seen cap rates cool substantially as interest rates have come up, but sellers, well, they don't want to see that. And so they've listed their properties at more than they're worth in today's market. Then you have an operator who might be pretty new that puts together a really great pitch deck. He's got a smooth sale. She's got all her numbers and all her figures, and she runs those past you so fast you can't figure out what's going on. And then you don't really look at the capital stack structure. You don't look at what the exit plan is, and you don't look at the fees that the operator's charging. Heck, most people don't even catch that a lot of syndicators don't even put their own capital into the deal. So what are some of the risks that are in the value add deals? Well, a lot of people are still thinking that it's 2021, where you can come in and put a coat of paint on things, remodel a kitchen, and throw some new deck chairs by the pool, and you can raise rents $300. Well, according to the national news, markets aren't appreciating all over. Certain markets are, and they're staying healthy and strong, but markets like Austin and parts of Florida are starting to see the cracks in raising rents too high. They're starting to see where cash flow is being hampered because they can't keep raising rents because the tenants just don't have the money to pay it. So you've got to look at all those things and understand what is the risk, what are the red flags, and where are you really going to go with this deal? What are the most common red flags that I see in deals today? Well, it's the first one is looking at what cap rate they're buying the deal at and what cap rate they think they're selling the deal at. As we've seen interest rates rise, we've seen cap rates come up 2 to 3%, which is huge on a deal. We also saw a lot in 20 and 21 where people were buying a deal at, let's say, a 4.5 cap, but they were modeling selling the deal on a 4 cap. You really should be modeling a deal, if you're modeling it at 5.5 cap in today's market on a brand new product, you should be modeling the sale of that deal at least 3/4 of a point higher, just to give yourself leeway in the market. Because if interest rates continue to rise, you're going to see that erode your cap rate. And that's really where you're getting your benefit. So if interest rates go up another 0.5%, you can imagine what that's going to do to your cap rate. And if you haven't penciled that into your deal, you're going to find yourself underwater very quickly. But investors love to chase these deals, even when the math doesn't pencil, because they've got a great shiny deck and it's in a market that they love and everybody's buying in Nashville right now. So why shouldn't I? Well, those are some of the problems. You need to do the math. You need to look at the fundamentals, because that's really what's changed from the hype and hyperbole that we saw in 19 and 20 and 21, where you could buy anything with the interest rates that were there, add a couple of bucks in rent, and sell for even more than what you bought in a very short period of time. But the reality is, real estate is a long game. And anybody that's trying to get in and out of a deal in about 3 years is probably making a mistake in this market. It wasn't a bad idea in 19 and 20, but we didn't know how fast interest rates were going to rise. And so we wound up in trouble with some of the deals that people bought and how they're having to get out of them now with higher interest rates and higher cap rates. I've seen investors put money into projects where the returns looked great on paper, but the sponsor had no clue how to operate the project and get it to where PPM said it was going to be. And I've seen people bring me deals they were already in, asking me if they made a mistake, and too often they had. And I had to tell them, being passive doesn't mean being blind. You have to ask smart questions, and you have to know what real good operators look like and how to vet them properly. I've come across a lot of people who've gotten involved in deals. I was just talking with one of my investors the other day who had invested family money into some deals in supposedly great markets because they had high appreciation 3 and 4 years ago, and now they were facing capital calls. And when they were unable to make the capital call, they risked one of two outcomes. One, they were going to be diluted as they brought in other investors, or if the sponsor wasn't able to find other investors, they risked losing their whole investment altogether. And so when you're looking for deals right now, you need to look at the deal. You need to look at the sponsor. You need to look at the operations that they have in place in other deals to see how at risk you really are. Because you can't put shiny documents, you can't put a great looking PPM in front of the real math and the market. You have to drill into all of it. One of the things that I've started looking at a lot lately is what other operators are doing in my market and how their banks are treating them. What I mean by that is there are some operators that are one step away from losing the property, and the properties are in substantial trouble. And if you start to see that, you're going to see people chase occupancy to keep their loan in place, even if that means undercutting the market and not taking advantage of the ability to raise rents. So you really want to pay attention to those around you and what they're doing, because it has a tremendous impact on what you're doing right now. So passive investing doesn't mean set it and forget it. It means picking partners who think long-term, communicate clearly, and operate with discipline. And in 2025, it means having liquidity, staying local, and staying skeptical. So now when someone brings me a passive deal, the number one thing I look at is what is the cash on hand? What are the exit plans? Do they have multiple? Because they're going to be necessary. And when are they thinking that the cash flow starts, and to what degree? Once we've evaluated those and lined those up with the investor's true intentions, then we can begin to dive in further. But oftentimes I find that those are out of alignment before we even get started. And if you're brand new to syndication, these are steps that you're definitely going to want to take to make sure that you do that. In fact, step one, if you've not invested in real estate or syndication, I would suggest that you sit down and go through what are your goals and objectives. What are your top 5 things that you want real estate to do? And then evaluate, number 1, are you being practical? And number 2, are the deals you're looking at meeting those needs? Because if they're not, then you're simply chasing something that somebody else thinks is a good idea, and it may not fit you, your goals, and what you're trying to accomplish with your money. So if you want to stop chasing average deals and start thinking like a pro, it starts with who you partner with. I work with a small group of passive investors, and we do things differently. If you want to see what that looks like, hit subscribe and book a call. The links are below. Another big mistake that all investors make is that they pay taxes. In my last deal worth millions, I paid 0 in taxes, and I'll show you how. Watch the video next. It's on the screen below.